Hello everyone, very good afternoon and welcome to today's webinar on the IEA Gas Market Report Q3 2025. I am Rohit Yadav from Business Development Team at Indian Gas Exchange and I will be your host for today's session. On behalf of IGX, I would like to thank you all, the participants for joining us today. We all are keen to understand the latest development and outlook in the global gas market as the natural gas market is ever evolving and the accurate and timely information plays a key role in informed decision making. That's exactly what the IEA consistently provides, and we are privileged to bring their latest insights to you today. Today, we will discuss the IEA's quarterly report, which will offer a comprehensive short term outlook on natural gas demand, supply, as well as a crucial analysis on the market fundamentals. Before we dive into the agenda, I would like to welcome all our esteemed speakers who have joined us today. Firstly, Mr. Rajesh Mediratta sir, MD and CEO, Indian Gas Exchange. He has a rich experience of 34 plus years in energy sector and has been associated with Indian Gas Exchange since its inception. It's been now more than 5 years. The well-known personality in global gas market, Mr. Gregory Molnar, gas analyst IEA, who brings over 17 years of experience in the energy sector, including 7 plus years in IEA. Last but not the least, Mr. Frederick Ritter, gas analyst, IEA, with 13 plus years of experience in the energy sector and 2 plus years of experience with IEA. Thank you all the speakers for joining us today. Before we start, I would like to request the participants to park their question in Q&A section. We will take questions separately. To kick-start the session, I would like to invite Mr. Rajesh Mediratta sir for his opening remarks. Sir, the floor is yours.
Thanks, Rohit. Good afternoon, everyone, and a very warm welcome to our webinar on the IEA Gas Market Report Q3 2025. It is a pleasure to have with us today Mr. Gregory Molnar, gas analyst from IEA, and also Mr. Frederick Ritter. He is also gas analyst. Thank you both for joining us. At IGX, we continue to strive towards providing useful market information for our market players, and we are thankful to IEA who always support in our endeavors and also give very useful insights to our market participants. I'll just give you initially a brief introduction to IGX to start with. IGX started in 2020, which is a delivery-based electronic platform under regulatory oversight of PNGRB. Last year, we traded about 60 million MMBTU, which is equivalent to something like 4.1 mm SCMD. In terawatt-hour terms, it is 18 terawatt-hours. We have several contracts ranging from intraday to month to quarter to 6 month, and they are available at about 17 delivery points in India, and out of which few are LNG terminals, few are domestic gas sources, and there are few which are interconnection points of two pipeline networks. We have 51 members and more than 200 plus clients. So whole of gas universe is associated with us. Our benchmark index, GIXI, discovers price for gas in India, which actually discovers from the mix of supply sources in all demand segments, which is our market players have found very, very useful, and they keep referring to our GIXI benchmark. GIXI this month is at $11.8 per MMBTU. In comparison, generally it is remaining at a discount to international benchmarks like WIM. Today WIM is about 13.3, TTF is 13.2. Henry Hub, which is if you take the landed price of Henry Hub at Indian coast, it is about 10.6. Of course, it is lower than Indian gas benchmark. And I'm very thankful to Greg that he normally publishes a good comparison on his LinkedIn post, and that is really useful source of information for us to compare our prices with the international prices. Now, a bit on gas market outlook. So basically, in India, we all know that our markets are growing. Last year, we consumed something like 68 BCM of gas. split almost evenly across domestic supplies and imported LNG. IEA also published a gas market, Indian gas market report that was launched during India Energy Week in February this year, and their estimates for 2030 is 102 BCM, 102 BCM, which is at say 50 to 60% growth over 2024 figures, which is at a CAGR of 10%. And of course, there are many who estimate more optimistically at 110 BCM, 235 BCM. But of course, there are a few others who are less optimistic of growth of Indian gas markets, and they are even less than one. There are few estimates which are even less than 102 BCM. But everybody expects that on demand side, we will definitely grow. Of course, CAGR may differ. Our CAGR we expect is 10%. And the best segment which will have growth is CGDs, which we expect to grow at something like 19%. Next one, refinery will be about 15%, but other sectors will grow more or less at 6 to 7%, except for fertilizer, which is we expect not to grow much, and it may remain flat during next 5 years. On the supply side, domestic production actually meets 51% of our current demand, and which is expected to reach something like 45 BCM, which is currently 35 BCM. And our dependence on, but that makes sure that indicates that our dependence on LNG imports will keep on increasing. It will double to something like 60 BCM by 2030, as per the estimates. To support this, we are investing heavily in infrastructure. We all know that we have huge ambition to increase our pipeline network. Today, the pipeline network is more getting access to west and north, but later we are also adding pipelines for reaching to remote area, to major areas of demand centers in south, east, and northeast. And today, which is about 25,000 kilometer network, that we expect to increase to 35,000 by 2030. LNG terminal capacity also, we currently have over 65 million ton per annum, 52.7 million ton per annum, which we expect to increase to 65. And of course, CGDs will grow over time, and there's a lot of pipeline network addition which is happening in the CGDs, whose licenses were awarded in 3 to 4 years back, and all of them will keep adding their networks, and then that will actually help push our demand growth substantially. Finally, the regulatory environment is also evolving positively. Discussions are around for bringing gas under GST, new access code rules. Steps are also being thought for creating an independent system operators, and many more which are happening on the regulatory and policy side. Since we import substantial part of our needs, almost 50%, so it is very important for us to get global outlook of this commodity. And to get international perspectives, we would like to hear our two experts who have joined today. So besides this webinar, we also propose to do a series of gas market reforms webinar on policy and regulatory for Indian market conditions. Since IEA has got rich experience in their journey of observing and also being part of developed gas markets evolution, particularly in EU. They also have launched the Indian Gas Market Report 2030, and there they have outlined policy options for India, which will help to increase gas market competition. And all of the list which they have cited in that report is so relevant to India. So we would definitely like to be associated, and we would like them to be part of our webinars, and we would like to hear them more on the policy and regulatory side also. So as we will move forward, we will definitely do something more with them. We will hear more from them. And then now, at least today's topic, we would like to Welcome both of our experts, Mr. Greg and Frederick. Floor is yours. Thank you.
Yes, sir, Madirata. Dear Rohit, many thanks for your kind words of introduction. It is a pleasure and an honor to be here today with you virtually. It is not the first time. It became, in a way, a tradition that we share and discuss gas market developments with colleagues from India, and many thanks for IGX to facilitate this dialogue, which is indeed of great importance for us. Please allow me to share my screen so that we can see our presentation. Apologies. Okay. So today's presentation is very much building on the key findings of our quarterly gas report, which has been just published at the beginning of this week and is available free of charge on our website, iea.org. On the front page, we see the LNG carrier Glasgow. This LNG carrier took the very first shipment from LNG Canada, bringing these first cargoes indeed to the Asian markets. And indeed, this shows that we are in a very dynamic phase of global gas and LNG market development. So today's presentation, we will first start with a global overview. Then in the second part, we will focus a bit more on Europe. And then my colleague, Frederick Ritter, will give us a closer overview of the Asian market developments, as well as on the evolution and the outlook for the global LNG market. So I think the starting point for us is to have a look on the developments of natural gas prices. And here we show the evolution of Asian and European gas prices since the start of 2024. The light blue line indicates JKM, a key benchmark for Northeast Asia. The dark blue line is at TTF, the European benchmark, and the gray area between the two is the spread. And I would like to make three comments related to gas prices. One is on the absolute price levels, and the second will be on the spread, and the third one on the volatility we see on the market. I think that when we look at the average price level in the first half of 2024, we see that TTF have been averaging at 40% above its last year levels in the first half of 2024. And JKM prices were trading 30% above their last year levels in the first half of 2024. And this is reflecting that we are in a tighter market environment, but also geopolitical tensions have contributed to more upside in terms of price movements. The second point relates to the spread. If you look back at the first half of 2024, we see that Asian spot prices were trading almost $1 per MMBTU over TTF, and this indeed incentivized flexible LNG cargoes to deliver more LNG towards the Asian markets. In contrast, the TTF JKM spread collapsed to near zero in the first half of 2025, and on a netback basis, Europe was the preferred market destination for many suppliers, including the United States. And we will discuss later on in this presentation the evolution of global LNG flows in the first half of the year. And the third point relates to price volatility. If we look at TTF, we see that the volatility on the months ahead contract was 70% higher than the historic volatility for the TTF months ahead contract. And this higher volatility has been partly supported by geopolitical tensions, including the conflict between Israel and Iran. As we can see, it led to quite some steep price swings at the end of June. Now, in this quarterly report, we have a special section dedicated to the Middle East. But here I just would like to highlight that this region is of crucial importance both for global and regional energy and gas supply security. On the first chart, we showed the flows and the LNG flows transiting the Strait of Hormuz, which alone accounts for approximately 20% of global LNG trade. And as we can see, most of the volumes are destined to the Asian markets, over 80%. But of course, any disruption of flows via the Strait of Hormuz would have implication on the entire global market, and the impact of this supply shock would be dispersed across all LNG importing markets. On the second graph, we show the growing importance of Israel as a regional pipe gas supplier, in particular to Egypt, where it has been accounting for roughly 15% of Egypt's primary gas supply in the first 4 months of 2025. And indeed, when Israel had to shut down the production at some of its fields and consequently had to reduce its pipe gas deliveries both to Jordan and to Egypt, it highlighted this strong intra-regional interdependence. Both Jordan and Egypt consequently announced the reduction of gas deliveries to industrial consumers, including to fertilizers, which I think again highlights and sometimes overlooked link between gas supply adequacy and food supply security. And on the third chart, we are showing Turkey's primary gas supply mix. And here we would like to highlight that Iran is also playing an important role as a regional pipe gas supplier, accounting for almost 10% of Turkey's primary gas supply in the first 4 months of the year. But it is also an important pipe gas supplier to Iraq. So at the agency, we continue to closely monitor market developments in the Middle East and, of course, beyond. Now, despite all the volatility we see in the market, I think it is also remarkable to note how strong the correlation remained between TTF and Asian spot energy prices over the first half of 2025. Indeed, this correlation stood close to near record levels at 95%. And this is also in a sharp contrast with the correlation we have seen earlier in the 2010s, when we look at the TTF JKM correlation, it averaged at just around 0.4 between 2012 and 2016. And since 2020, this correlation has been standing at above 0.9. And this indicates that there are profound structural changes in the global gas market, including the growing share of destination flexible Henry Hub indexed US LNG, which today accounts for more than 25% of global LNG supply. But it also reflects the growing share of spot LNG, which is today roughly 30% of global LNG trade, and of course, the rising role of portfolio players. And all these factors are contributing to the growing liquidity and flexibility of the global LNG market. Now, let us take a step back and look at the evolution of the current market fundamentals. And let us start with the supply side. So when we look at the first half of 2025, we see that global LNG supply has been growing and expanded by around 4% or 12 BCM. And as we can see on this chart, this has been largely supported by new LNG liquefaction projects in the United States, including Plaquemines LNG in Louisiana, which alone accounted for about 2/3 of incremental LNG supply in the first half of the year. But of course, we have seen additional volumes coming from Corpus Christi Stage 3, Freeport LNG, and Tortue FLNG in Africa. In addition to that, we see a continued ramp up of piped gas volumes by the Power of Siberia pipeline, which connects Russia to China. Here we have seen volumes increasing by around 25% year on year, adding almost 4 BCM of natural gas to the Chinese market. Now, all of this growth has been partially offset by the lower pipe gas supplies to Europe, both from Russia and Norway, which translated into a decline of about 8 BCM. And in addition to that, Europe's storage injections were significantly higher in the second quarter of the year, which indeed further tightened market conditions and left less traded gas volumes, which can support actual demand growth. Now, when we are looking at the demand side, we see a clear slowdown, but also a very varied pattern across the key gas consuming regions. The headline figure here is that natural gas demand growth slowed down to an estimated 1% in the first half of 2025. This compares to a growth rate of 2.8% in 2024. So this is a clear slowdown. And most of the demand growth has been actually concentrated in Europe and in North America. In Europe, we have seen a growth of 6.5% or 15 BCM. And as we can see on this chart, most of that growth has been actually supported by the power sector, where there have been less renewable power generation, and this increased the call on gas-fired power plants. In North America, we estimate that natural gas consumption increased by 2.3%, and this has been mainly supported by the colder winter weather conditions in the first quarter of the year, but also some gas demand growth in the industrial and the energy sectors. In contrast, in the power sector, we have seen quite some decline in the use of natural gas, mainly due to gas-to-coal switching dynamics in the United States. Central and South America is really a mixed bag, I have to say. But the two major markets, Argentina and Brazil, they both experienced quite a strong increase in gas to power demand, as well as some gains in gas use in industry. And consequently, the region's gas consumption continued to increase in the first half of the year. When we look at Eurasia, here we estimate that natural gas consumption declined by around 2%, and this has been mainly due to the unseasonably mild winter in Russia in the first quarter of the year. And then we look at when we are looking at Asia, our estimate is that the region's natural gas demand declined by 1.5% due to a combination of factors, including weaker macro fundamentals, relatively high gas prices, which are incentivizing some gas to coal switching. And of course, Frederick will elaborate on that in a much greater detail in the second half of the presentation. And when we combine all these dynamics, we indeed see that there have been quite a slowdown in global gas demand in the first half of the year. Now, let us move again to the supply side. Here we would like to discuss a bit in more detail our outlook for LNG. For the full year of 2025, we expect that global LNG supply will expand by 5.5% or 30 BCM, mainly on the back of new projects in North America, including LNG Canada, which just started operations and is already delivering LNG to the market at a good pace. But when we are looking at 2026, we also expect that global LNG supply growth will accelerate to 7% or 40 BCM, which would be actually its fastest pace since 2019. And as we can see, this growth will be once again very much supported by North America, but also by other many projects across the world. And here, just let us name a few of those projects. Of course, Plaquemines LNG, which started operations at the end of 2024 and is ramping up its deliveries at a very, very rapid pace. We have Corpus Christi Stage 3, which is expected to ramp up to full capacity in 2026. We have LNG Canada, we already mentioned, and we also expect that the product will reach full capacity by 2026. We have Golden Pass Train 1, which just started receiving the first drops of feed gas, and we expect that operations here will start in the last quarter of 2025. And then we have Costa Azul LNG in Mexico, which is expected to start operations in the spring of 2026. Outside of North America, the single most important project to look at is, of course, Qatar's North Field East expansion. The first train is expected to start operation in the middle of 2026, and volumes will be ramping up throughout 27, 28. We are talking about major LNG project, the world's largest one, with a capacity of 45 BCM. And then in Africa, we have Congo FLNG Phase 2, which is expected to start operations towards the end of 2025. And most of these volumes would be actually benefiting the European market. And then last but not least, in Australia, Pluto LNG Train 2 is expected to start operations in the second half of 2026 with deliveries mainly destined to the Asian market. So altogether, 2026 will be a step change for the global gas market, marking the first year of the next LNG wave. And it will be also a test on how demand responds to stronger supply growth, especially in Asia. So for the full year of 2025, global gas demand growth is expected to slow down and to increase by just around 1.3%. Now, this compares with the 2.8% growth experienced in 2024. And this is partly due to the macroeconomic uncertainties, the tighter market conditions, and the higher price environment, which is, of course, weighing on gas demand growth in some of the price-sensitive import markets. And I would like to draw your attention that natural gas demand growth is expected to slow down to less than 1% in Asia, which would be its weakest growth since 2022. Now, global gas demand growth is expected to accelerate to around 2% in 2026, and it would also reach a new all-time high. Improving supply fundamentals are expected to support stronger demand, especially in the fast-growing and price-sensitive Asian markets. Natural gas demand in Asia is expected to increase by over 4% in 2026 and to account for roughly half of global gas demand growth. And here I just would like to highlight that we expect that India's gas consumption will increase by 7%, and the country alone would account for over 6% of global gas demand growth, which is quite spectacular. In North America, we expect rather limited increase of less than 1%, and this is mainly on the back of some recovery happening in the power sector. In contrast, in Europe and Central and South America, we expect lower gas demand, mainly because of the expansion of renewables. In Eurasia, natural gas consumption is expected to increase by around 2%, partly driven by the recovery in the weather-sensitive sectors. And combined demand in Africa and the Middle East is projected to increase by 3.5% amid higher gas use in industry and the power sector. So from a sector perspective, about 50% of global gas demand growth in 2026 would be concentrated in industry and the energy sector. The contribution of the power sector would be still quite significant and account for approximately 30% of global gas demand growth, while gas use in the residential and commercial sectors would increase by just around 1%, assuming average weather conditions. So one additional point I would like to draw our attention on is LNG final investment decisions. Despite all the macroeconomic uncertainty, LNG FID activity remained quite robust in the first half of 2025. More than 50 BCM per year of LNG liquefaction capacity was sanctioned or started construction in the first half of the year, and we can clearly see that the United States is leading the way. This includes Louisiana LNG, which reached FID in earlier this year in April, the CP2 project, which started construction in June, and the Corpus Christi Train 8 and 9 project, which reached FID at the end of June. So with that positive note, let us move to the European market to give us a short overview of the key dynamics in that region. So on this slide, we are presenting how natural gas consumption evolved in the first half of 2025. As mentioned earlier, our estimate is that Europe's natural gas demand increased by 6.5% or 15 BCM. And this has been partly supported by stronger gas use in the residential and commercial sectors because of a colder Q1. We estimate that here natural gas consumption increased by around 5%. But the most important driver has been indeed the power sector, where we estimate that gas to power demand increased by 20%. And this has been largely supported by lower renewable power output. In Northwest Europe, we had rather slow wind speeds, with wind power generation declining by around 8%. And in Southern Europe, we had low hydro availability, which reduced hydro power generation by around 12%. In contrast with these two sectors, in industry, we have seen a decline of around 2%, mainly due to the higher gas price environment. And first data suggest that most of this decline in industry was concentrated in refining and in the fertilizers sector. So another important aspect to consider when we speak about European demand is the storage operations. Now, Europe closed the 2024-25 heating season with relatively low storage levels, which were standing 25 BCM below their last year levels. And as a consequence, storage injections have been much stronger in the second quarter of 2025 than last year, an increase of around 35% or almost 7 BCM in absolute terms. And at the moment, we remain about 10% below last year levels in terms of inventory levels, despite these rather strong storage injections. So moving from the demand side to the supply side, I think it is quite important to note that while Europe's demand and storage injections increased sharply, the region's pipe gas supplies declined in the first half of the year. First, we have Russia's pipe gas deliveries to the European Union, which dropped by 45% compared to last year, following the halt of the gas transit flows via Ukraine. In addition to that, Norwegian pipe gas deliveries to the rest of the continent declined by around 4.5% or almost 3 BCM, mainly due to higher maintenance activity and also some unplanned outages. And we also received a little bit of less gas from Azerbaijan. Now, when we combine this stronger domestic demand with lower piped gas deliveries, this naturally increased Europe's call on LNG imports, which surged by 25% to an all-time high of over 90 BCM in the first half of 2025. And here I also would like to draw our attention that the United States alone accounted for almost 90% of incremental LNG supply to Europe during this period, which of course reinforced the US position as Europe's largest LNG supplier. Now, looking to our summer outlook, we expect that Europe's LNG appetite will remain quite strong over the summer season. First, the European storage levels are still well below last year levels, standing about 10% below last year levels, which means that there will be more space for storage injections over the coming months. Second, we expect less piped gas, mainly from Russia, due to the halt of the Ukrainian transit route. And third, the European Union's piped gas deliveries to Ukraine has been also increasing very significantly to support storage refill operations in Ukraine. So when we add together all these pieces of this puzzle, we see a case for a continued strong increase in Europe's LNG imports, and we expect that Europe's LNG inflows will increase by 1/3, or approximately 25 BCM, through the April to October period, which in a way will keep market fundamentals tight over this period. Now, this slide just gives us an overview of our forecast for European gas demand for 25 and 26. For the full year of 2025, we expect that Europe's natural gas demand will increase by around 3%, mainly on the back of the strong gains we have seen in the first half of the year. But in 2026, it is a rather different story. We expect that European gas consumption will decline by around 2%, mainly because of the continued expansion of renewables. We expect some gains in industrial gas demand, some recovery happening here, and we also expect some increase in the buildings sector, assuming average weather conditions. But those gains will be not sufficient to offset the expected declines in the power sector. And of course, this lower European gas demand will contribute to a decline in Europe's LNG imports, and this will indeed support a stronger demand growth in the Asian markets. And with that, I would like to give the floor to my colleague, Frederick Ritter. Thank you for your attention.
Great. Thanks very much, Gergely. Hopefully everyone can hear me well. So I'll start us off, as Gergely mentioned, talking about the Asian market first, and then we'll dive into LNG as well. Why we're talking about both of these elements is that they're absolutely central to the shifts in global market dynamics that we see happening both this year and in 2026. Asia has been the primary driver of global gas demand growth in recent years, as we'll see on the next slide. Its share of global gas demand upside has fluctuated, of course, on an annual basis, but the region accounted for about 60% of cumulative global demand growth over these past 5 years. And for this reason, what happens in Asia is a significant factor in defining global dynamics, and the 2024 to 2026 period shows this quite well. Now, from nearly 6% in 2024, Asian demand growth is set to slow significantly in 2025 to under 1%, as we've already learned with Gergely earlier in a couple of slides. We see this stark shift on this slide. The chart on the left, we see the evolution of growth rates. So the numbers in black is the growth rate for Asia, and the number in gray is the global demand growth rate that we expect over these years. So with the expected slowdown of Asian demand growth in 2025, global growth drops from close to 3% in 2024 to just around 1.3% this year. Now, China is the first factor, of course, to look at here, with economic headwinds that emerged in the later part of 2024, essentially leaving their mark on full year 2025 growth. That's the dark green bar that essentially shrinks, almost vanishes in 2025. Now, we see that progressive nuclear recovery in Japan is also a key turning point in that turnaround that we see the slight growth trend from 2024 disappearing in 2025 in mature Asian markets. That's that light green bar. And of course, we have other markets. India is at the head of the pack, and the rest of Asian markets as well have their role to play in this slowdown, notably with LNG availability playing a role in tempering growth in some of these markets. Of course, we'll dive into this LNG question a little bit later in a few slides. Now, looking at the chart on the right gives us a little bit more insight into the sectoral breakdown of shifting demand dynamics. The two sectors that are leading the way in demand growth last year are also the two sectors that are behind this year's slowdown. Now, weaker economic fundamentals are already hitting industry, demand for natural gas, as we see in the chart, and the combination of both renewable deployments, nuclear recovery in Japan, for example, and also relatively high global gas price benchmarks has scaled back growth prospects for gas in power generation across the region. In 2026, however, we expect to see a clear turnaround in Asian demand dynamics. A bit later, I'll dive into the underlying supply factor behind this, LNG liquefaction growth, of course. But here we expect the return of China as the region's main driver and a recovery in industrial demand as improving supply conditions essentially work in parallel with improving economic outlook for individual markets and the region as a whole. So as mentioned earlier, where Asian dynamics go, the world kind of follows. We forecast Asian demand growth to recover to about 4.4% next year, helping pull global gas demand growth back up to nearly 2%. Now, let's dive into a few individual markets here. I want to start with China on the next slide because this is where much of our Asian story is unfolding. We're starting off here with historical demand by sector and at a quarterly granularity. What we see is that after a period of strong growth and recovery in 2023 and much of 2024, a shift has clearly taken place starting in 2024. One key factor that I've already mentioned is the emergence of economic headwinds in the later part of last year. But what we also see is that over the winter months, these past winter months, mild weather has also played a role in scaling back Chinese natural gas demand growth. The downturn actually deepened in first quarter of this year, and we estimate that demand fell by around 1% over the first half of 2025, which is rather exceptional for this market. We expect these early 2025 dynamics to actually condition much of the full year trend for China. But we do see a mild recovery emerging starting in second quarter of 2025, supported notably by less acute downturn in industrial demand for natural gas, which itself is tied to improving economic prospects. Now, we've seen this downside risk emerging for China for quite a while now, and we've continued to downgrade our 2025 growth outlook in our successive gas market reports. Our current view is for Chinese gas demand to grow at a little over 1% this year, which is above the total Asia growth rate, but also slightly below the global growth rate expectation. Now, in the next slide, let's focus a little bit more on this outlook part for the Chinese market. China retains structural growth elements, of course, in its gas market that under the right macroeconomic and price conditions. Sorry, if we can just move to the next slide. So thanks very much, Gargay. So under the right sort of macroeconomic and price conditions, we do expect these growth elements to reemerge relatively quickly. So despite the significant slowdown that we see in growth this year, we expect to see a return to around 6% growth in 2026. Now, industrial recovery, road transport, growing distribution network connections are all behind this. Under our latest outlook for 2026, China would once again account for about 60% of Asian demand growth and about 30% of global gas demand growth for all this for next year. Now, let's take a quick moment to focus on the supply side of the equation. In 2025, incremental supply from domestic production and pipeline imports is expected to be more than enough to cover demand growth, indicating that Chinese LNG imports are set to drop significantly. And indeed, they're already down by about 20% in the first half of this year. And we expect this drop to total around 11% by the end of this year. In 2026, the picture, of course, flips. The Power of Siberia pipeline with Russia will already have delivered its upside in 2025. And while we expect domestic production to continue growing at a relatively healthy rate, this won't be sufficient to cover incremental demand. So LNG is set to play the balancing role again, but in the opposite direction as in 2025. With even more LNG coming to the market in 2026, again, we'll see this in a few slides, we expect Chinese imports to return to strong growth, bringing total imports to new record high for the country. Now, looking at the chart on the right, we see this balancing role of LNG for the Chinese markets. The light blue line that we see in the chart has made a number of directional shifts these past few years. In 2022, there was a year-on-year drop in Chinese demand that led to the country's first fall in LNG imports on an annual basis. This is also the year where European imports, of course, as we all know, surged as a result of the drastic turndown in Russian pipeline flows. Chinese LNG imports then returned to growth in 2023 and 2024, essentially backing up growing gas demand over these years. And now again, LNG is set to play that balancing role in the Chinese markets. And the flip side to this, China is expected to be a key balancing element in the global LNG market, as we'll see in the next section that I'll cover. What about other markets in Asia? What about India? And what about other Southeast Asian markets? Let's look at this on this slide that's just come up. So China has an overwhelming role, of course, in Asian gas demand dynamics, but it's certainly not the entire story. So here we're putting India and the rest of Asia side by side, notably to show the different sectoral drivers behind these different markets and their somewhat similar relationship to LNG when thinking about their growth trajectories in the next few years. Now, Indian gas demand fell rather markedly in the first part of 2025, notably due to fuel switching in industry and refining, as global gas prices have remained relatively high year on year. Due as well to lower power sector gas burn, despite the fact that month on month we've seen quite a different story between high power demand and low power demand in line with weather patterns. Now, in total, we expect India's gas demand to fall by about 1% this year. Over the first 5 months of the year, we estimate approximately a 7% decrease year on year in demand. So that means that over the full year, the rest of the year, we do expect demand prospects to improve. But this fall in 1% over the full year 2025 is down from 10% growth last year. So that's a huge spread when we think in percentage terms. We expect market conditions to turn around next year with return to growth across all sectors and most notably across industry, which is the country's largest demand sector. Expanding city gas distribution, expanding CNG filling station networks, of course, and rising industrial use of gas on top of growing electricity needs are all underlying factors behind this return to important demand growth in 2026. Now, when we shift to the other markets in Asia, taken together, these other emerging Asia markets are driven primarily by a different sector compared to India. These are generally driven by power generation. That being said, we also expect recovery in 2026 in this grouping to be supported by industrial demand for gas. This marks a clear upward shift compared to recent years as improving macroeconomic conditions, more LNG availability, and overall growing energy needs in these economies combine for renewed dynamism in this region. Now, I think it's again worth taking a moment to discuss the supply side of these markets. Domestic production in some markets is facing the impacts of aging resource basins and less dynamic activity than has been hoped for in recent years. And the chart on the right gives us another piece of this supply puzzle. This is the share of LNG in total supply by market. What we see is that India is at around 50% reliance, more or less, on LNG, and other emerging Asia-Pacific markets have been increasingly reliant. So at a lower level, but a rising trajectory, increasingly reliant on LNG as well. So in relatively tight market conditions, a high reliance on LNG can condition how accessible gas is to certain buyers. And we know that many Asian markets are rather price elastic, price sensitive buyers, sometimes turning away from the spot LNG markets when prices get too high. And this is something that we have seen in the first half of 2025 as competition for LNG volumes has remained high. Gerge already outlined the dynamics in Europe, which are essentially pulling in a lot of, or leading to the continent pulling in a lot of LNG volumes. So when we think about future demand growth in markets like India, in markets like smaller emerging gas markets in Asia, we need to understand the growing link between LNG supply availability and their growing demand. So now that I've alluded to it for quite a few times, what does our LNG outlook look like for the rest of 2025 and 2026? This we'll see on the next slide. So 2025 marks the start, if you will, of the next LNG supply wave that is set to cover the second half of this decade. We expect LNG supply to grow by about 30 BCM this year. That's around 5.5%, which is a clear acceleration after 2 years of rather modest supply upside, as we see in 2023 and 2024 on this chart. Now, in 2026, we expect a further 40 BCM of LNG to reach the market, with a cumulative 2025 and 2026 supply upside almost as big as the cumulative LNG supply growth of the previous 5 years. So in 2 years, we have almost as much LNG coming online as in the previous 5. North America is driving the supply growth, with US projects leading the way, but also significant upside coming from Canada and, to a lesser extent, Mexico as well. Projects like Plaquemines LNG, the Corpus Christi Stage 3 expansion, of course, and LNG Canada have already begun this year, and they are set to deliver upside to the market through the rest of this year and into 2026. We also have Golden Pass in the US, also on the list of upcoming projects. Now, thus far, ramp up in new projects this year has been rather successful. When we talk about successful here, it's that projects have ramped up quickly, and they've done so without major hiccups. And this has brought new supply to market faster than expected earlier in this year. That being said, the global market remains somewhat vulnerable to unexpected outage risks. Instances emerged earlier this year in Q1 in Norway and Nigeria. This is a reminder that potential issues like these can easily tighten the LNG supply balance and can reduce the net growth we have forecasted here. So to recap, the next LNG supply wave is indeed ramping up in 2025, accelerating and really in full swing in 2026. But we need to look at the import side to better understand how our global gas market balance is actually shaping up. So on this next slide, we're showing 3 years with 3 different underlying dynamics at play in terms of LNG imports. LNG supply growth is accelerating, as we saw on the previous slide, but competition for this LNG is also intensifying in 2025. If we look back to 2024, we saw Asian LNG import growth, and we saw a decline in European LNG imports, broadly evening out in that year as LNG supply growth remained relatively weak. So Asia drove import growth back in 2024, while Europe acted as a sort of balancing market for LNG, paring back its buying. This year, we see these 2 regions switching roles, with Asian imports falling, essentially accommodating a significantly larger LNG take from Europe amid tighter domestic balance, as Gerge talked to us about in a few earlier slides. Just to recall, that's the fall in Russian pipeline flows, increased storage filling requirements over the summer months, and an overall more buoyant demand outlook. So what we see is that increased needs in Europe mean that cargoes are being pulled away from Asian markets into the European continent. Now, a few slides ago, we showed how LNG was at times a key balancing lever in the Chinese market. And we also mentioned that China was or could be a key balancing lever in the LNG market. And here is that role in action. As the world's largest LNG buyer, China is the primary element behind this downside fluctuation in 2025. Compensating for the fact that Europe is driving the markets this year on the demand side. So the driving role and the balancing role have switched between Asia and Europe, and China is that primary factor on the balancing side this year in 2025. So in short, while we have accelerating LNG supply growth this year, the global balance remains somewhat on edge in 2025 due to strong cross-basin competition for incremental volumes. This is something that we've already seen in flow patterns or trade patterns in the beginning of this year. 2025 marks the start of this next wave of LNG, but it remains a transitional year in terms of overall market conditions. However, we expect competition for incremental LNG to be a little bit less fraught in 2026. Number one, more volumes will be coming online, around 40 BCM we mentioned, and a relatively stable gas balance in Europe is set to leave much of the supply side to Asian markets and other markets. So under these conditions, a transitional phase in 2025 would give way to a more comfortable global LNG balance in 2026. With all that this implies in terms of buying conditions for more price-sensitive markets across the globe, and particularly in Asia. So this closes off the focus on Asia and LNG, but I'll take a couple of minutes just to run through a few key takeaways. So European hub and Asian LNG spot prices averaged well above levels last year in the first half of this year, essentially amid tighter market fundamentals. We also have to recall the role of geopolitical tensions fueling additional price volatility in the market that we've seen so far this year. Global gas demand growth has slowed to an estimated 1% in H1 2025, with growth primarily driven by Europe and North America. However, in stark contrast, gas demand declined in key Asian import markets, as we saw. Europe's LNG imports surged to an all-time high in the first half of this year amid stronger domestic demand, lower piped gas imports, and higher storage injections. Essentially, a tighter domestic gas balance in Europe means that it's pulling more heavily on the global LNG markets. Global LNG supply growth is set to accelerate to 7% in 2026, which would be its fastest pace since 2019, supported by the ramp up of a number of new major projects, of course, in North America. But we talked a little bit less about Qatar, Africa, and Australia. They are also important players in this upside in 2026. Improving supply fundamentals are expected to foster stronger demand growth, with global gas consumption projected to reach new all-time high in 2026. More LNG availability, more supply availability is driving renewed acceleration in demand growth as well. And finally, natural gas demand in Asia is expected to expand by more than 4% in 2026. This is supported by industrial demand. This is supported by the power sector. And improving supply availability, notably on the LNG front, is set to unlock a lot of price-sensitive demand across this region. So on that note, I'll wrap up the key takeaways, and I think we can hand it back to our hosts.